One of the complaints I often hear about Web3 is that a lot of the projects, companies, and ideas are solutions that are just looking for a problem, meaning that we already have suitable Web2 solutions and that just because your project is backed by blockchain doesn't make it necessarily the best real-world fit to solve the outlined problem. And to be honest, I understand this criticism. I think it's valid. As it is today, blockchain, crypto, NFTs, and Web3 can only do so much. But where it can find a good solution problem alignment is where it will thrive. And on this episode, I had the pleasure of chatting with Domingo, who's a co-founder of Homebase. Homebase is a company that starting today, February 28th, 2023, will offer the world access to fractionalized ownership to residential real estate for as little as $100. You see, Domingo and Homebase are trying to provide people the opportunity to gain exposure to residential real estate. Real estate, as we all know, especially in the single-family home sector, has gotten exceedingly expensive. This is where Homebase is working to bring a perfectly sound Web3 solution to a Web2 problem and help more people and families build wealth via real estate exposure. Something that for far too many people in the US has become seemingly out of financial reach. I'm Jarrett Carpenter, and this is More Than Blockchain. Domingo, welcome to More Than Blockchain. How you doing?
Doing really well, Jared. Thanks so much for having me.
Absolutely. Thanks for coming on. And you're in New York. Are you in New York right now?
I am. I live in Midtown area and been here for about 6 to 7 months now.
Okay, very cool. And I know you're from Texas, and we're going to get into your Texas roots because I think that that's a really important part of this episode. But actually, before we go any further, and I could have just asked you this off mic, are you going to be at NFT NYC?
Yes.
Okay, sweet. Well, we will meet up again, and I don't know, maybe we'll throw down another episode in person.
I would love it. That'd be great.
Yeah, because doing this is cool, but obviously, like, we're divided by a screen. So that's, it's just, it is what it is. It's what we have. And since I've been podcasting, in the pandemic, it allows you to do things honestly at distance. And let's go right there. Today, we're talking about the company that you've helped co-found called Homebase. And what you guys are looking to do, in as many words, is fractionalize real estate to make it more affordable so anyone can get in. And if you go to your website, which I'll shout out and you can shout out at the end, which is homebasedao.io, that's kind of like the thing you lead with, right? It says invest in real estate for as little as $100. And that sounds pretty sexy for any Gen Z, any millennial, anyone our age who looks at the real estate market. And you probably need, especially if you're in the Northeast, probably around 200. You need 200 cool just to put down to be competitive. So talk to me about Homebase. Talk to me about why Homebase and kind of how you got into crypto.
I've been following crypto since 2017, rode the Bitcoin wave up and then held it through the bottom as well. So I've seen the cycle. But I think what really stuck through with me was this idea of not relying on the current financial institutions and how, they led to the 2008 financial crisis. And I think one big piece of that, like what really resonated with me was just giving more people autonomy, giving people more power. And like the reason that Web3 really resonated was like, how do we decentralize a lot of that authority from big institutions back to everyday people? And so I think real estate is the culmination of that. I think we've seen it become really, really unaffordable in the last 10 years, especially. A big piece of it was private equity coming into the space. Actually, a big thread coming out today about how that affected real estate prices on Twitter. But that is a big piece of it. So what we're trying to do with Homebase is really just give more people the opportunity to start building wealth with real estate. I think there's a stat out there that says 90% of millionaires have real estate in their portfolio, and like it's a big piece of how they built that wealth. So just giving more people the opportunity to do that with as little as $100 is the mission of what we're doing. It's why we got into it. And happy to dive into my background as well and like what even was the mission behind this. But that's how we kind of got into the blockchain space and why we're doing Homebase.
So you, like me, also fell down into the Bitcoin rabbit hole. And I've been trying not to use rabbit hole because I think that has like a conspiracy theory connotation. But summer of 2017, I bought my first Bitcoin. I went to a Bitcoin ATM, took $200, put it in, scanned a QR code, and I was in. And I was like, okay, that makes sense. Fast forward to now, here we are. I'm running a podcast. You are, co-founder of Homebase. So yeah, actually, please talk to me a little bit more about some of your, the philosophies that brought you all the way from getting into Bitcoin and holding, and good job. I love to see diamond hands all the way up to now. Like, how did that happen? I'm sure when you look back as, I think Steve Jobs said in a commencement speech, he's like, a graduation speech, he said something like, it's always easy to connect the dots looking backwards. So if you could go ahead and connect some of those dots.
Yeah, I'll kind of share my story. So originally from Texas, as you mentioned, was born to two immigrant parents who came from Mexico. And growing up, they'd always tell me, Domingo, owning real estate's crucial to building wealth in America. For them, that was achieving the American dream. And so they really instilled that to me as a child. We'd always be going to open houses. I ended up then going to Penn, studied finance and real estate there. Thought I was going to go into banking. Instead, went to Google, did product strategy there for most of my time. But in my last 2 years there, bought my first multifamily in my home city of McAllen, Texas, and just realized like how much friction there was in that process. Took months to close. So many third parties had to get involved, and it was just like an awful process. The other thing I also came to the realization was after 5 years working at Google, still could not afford like any property in the Bay Area, which is where I was living at the time. And it was like, I'm literally like in the top 1% of earners in America. And if I can't afford real estate, like, where does that put everyone else? And that to me was just really depressing. And it was kind of like, what can be done to kind of make this, come up with a solution to this to help more people actually start becoming property owners? And the philosophy around Web3 and Bitcoin like really resonated as the technology stack that we would use to do that because of, I think, where Web3 originated from. I used to really like what originally WAGME meant, like we're all going to make it. Like I think in the beginning it was pure, and there was a lot of people that truly were like, we're in this new technology stack together. We're figuring things out together. I think since then there's been a ton of scams, a lot of rug pulls, a lot of like human greed that came out of that. But at the core principle, like blockchain's all about an open distributed ledger that showcases information that is available to anyone. And so that was the reason we chose to use that tech stack for Homebase. And so the homes that we bring on chain, we fractionalize using non-fungible tokens to do so. But a lot of that information will be on the Solana blockchain, available for anyone to see, whether it's price history, whether it's the deed of the home, whether it's like who transferred what. Like that to us is a core principle of how we're building this business and this product. And hopefully, at some point, all the debt for these properties can be done on chain as well by using like DeFi lenders to back mortgages. But at launch, everything's going to be all equity. This very first home in McAllen, Texas, that's launching next week, is going to be all equity as well. But with future plans to really move towards like this DeFi world. So I'll pause there. Realize I've been talking for a long time. So yeah, happy to answer anything around that.
So one of the things that I actually, before we dive into Homebase, how it works, Solana, talking about the new property that's about to launch, and also shout out my last episode where I actually talked about Homebase and I called it HomeDAO. My bad. I called it Homebase and I said I wasn't sure if I was supposed to say anything. You probably heard it and I was like, I didn't sign an NDA. Hopefully Domingo doesn't hate me. I actually want to go back to a conversation just about real estate to begin with, because I think that's a really important one that most people in the United States who are over the age of 25 can start to wrap their head around. And here you are, you're saying, hey, I was working at Google. I was in product and I was making a lot of money. Like I look around and I'm in the top 1%. But how is it that I cannot afford real estate? No, obviously this gets into that if you're buying a house in Florida or Texas, it's different than buying a house in Boston, New York, Philadelphia, or the Bay Area, right? We know this inherently. But one of the things that you said when we started the episode, which I just want you to touch on, if you have some stats, that's cool. If not, I know I'm putting you in the hot seat, is the idea of private equity, because this is something that has really happened since the pandemic. And I was reading something earlier this morning. There was a YouTube, I think it was like CNBC Business. I forget exactly what it was, but it was just talking about how basically the big money has come into real estate and your landlord is no longer your cousin. It's no longer the guy down the street. It's no longer Domingo who has his multifamily. It is some huge entity that you've only heard of and you didn't know that they were in real estate. So if you could, just before we get going, if you could talk about the struggle for people to buy real estate, and if we can kind of build that context, I think that's the problem, and then we'll get into the solution. So talk to me a little bit about private equity, because when I see like BlackRock or banks getting into real estate, it's kind of a scary thing.
Yeah, I mean, there's definitely a lot to unpack there. So it can give you definitely the high level of like what I've read about and what we've seen. So I think ever since 2008, 2009, like home prices really became depressed. They dropped like 50%. We're going to a housing crisis, and it led to a ton and ton of foreclosures. And so that was an opportunity for a lot of private equity firms saying, housing's not going anywhere. People still need to live in certain places. And we can turn these into single family rentals at scale. And so anything at scale has much better like costs that you can now break down over a ton of different properties. And so Blackstone is one example, spun up Invitation Homes. They started buying in masses, just all these single family properties in all like these Rust Belt areas and like different places throughout the country in which real estate used to be very, very affordable. And of course, like you could argue, they've done the same thing in New York City, but New York's always kind of been unaffordable. And like a lot of places like the Bay Area, same as well. Crazy prices just because there's so much wealth. But they started doing this in a lot of cities that didn't have as much wealth, but these big like private equity firms were just buying up all this property. And so what it ended up ultimately leading to was a lot of areas that normally you'd be your starter home for a new family now like wasn't available because these big firms have now bought these homes, and there's a lot less supply in the market, and there's no intention of them selling these properties. They're meant to be continuously rented out because that drives yield over time and then appreciation over time. And when they do sell it out, they don't sell it out to the American public. They'll sell it out to REITs, or they'll sell it out to like Zillow back when they're doing iBuying. So that really was like a big piece of a lot of real estate in America becoming unaffordable. My thread later today on Twitter actually showcases like a graph of when private equity started getting involved in real estate. So it's also been if you're a homeowner today and you've been holding since before all these private equity firms started buying in bulk, you've actually benefited a lot because price appreciation of these homes has really grown exponential since they started getting involved. So if you're in that group, all power to you. You made a lot of money through that price growth. But for the people that were born a generation after, it now feels as if properties just are too expensive for them to get with the current income that we've been receiving. So I think the like one stat I think that always helps with that is the case and Schiller like price to income ratio of a house to what like the average American household makes. And I think right now it's 8x. So what that means is that you need to work like taking all the income you make gross. So no taxes, no expenses. You need to save 8 years of that to buy the median house in the United States, which is incredibly expensive. And if you look at places like New York City, that of course being an outlier in terms of one of the most expensive places in America, the income someone makes to the rent they pay now is probably around like 50%. That's really a long-winded answer to saying how unaffordable it's gotten and kind of the history behind it and how some of these firms really profited from that.
No, that was absolutely brilliant. And for me, it's like it happened in 2020 where the big institutions came in and they just started buying property. But you're totally right. This is something that happened after 2008, 2009. And I remember in like 2011, 2012, if my buddy's listening, Corey, we saw this thing and it was about Detroit, how this millionaire basically went to Detroit, had $1 million liquid, and he hired all these interns, and all they were doing all day is sitting on the phone, calling up places and saying, "Can we buy your home for $3,000 or $4,000 cash?" And people were selling them because their homes were boarded up, and many times they were already indebted. So, or they would just basically pay the debt to get the deed, almost in a wholesale fashion. So, you're right. This has been going on for more than a decade now. And as you've said, those who had homes prior to 2007 essentially and kept them have seen massive, massive appreciation in their equity in their homes. Whereas anyone, primarily millennials and Gen Z, who have been trying to start families and trying to build wealth through a home, starting, I don't know, anywhere 2013, 2014 onwards, has been very difficult. And it's only getting more so. So thank you for building that context.
Of
And
course.
we now understand the problem. The problem is that real estate is essentially too expensive for, I'm going to say, the majority of people in the United States. If you're saying you need to save 8 years with no taxes, no expenses, you just live on the street and you just put money in your bank, and I don't even know how you survive for 8 years. Talk now, please, about how Homebase comes in, sees this problem, and is going to offer the solution.
Our philosophy at Homebase is we think real estate will continue to get more and more unaffordable over time. And so unless there's drastic policy change, that's just the reality, I think, of where prices are going to continue to go. And so at Homebase, like we're not trying to now like build affordable housing and like really change that infrastructure. I think a lot of companies have tried that. It's really, really hard to do with the private marketplace. And like you just don't scale very well. So I think the way we're approaching it is come into the realization that prices will continue to go higher and higher. We just want to give more people the opportunity to also benefit from that price appreciation, even if you don't have the required amount of money to put a down payment or like invest in a traditional, rental property. And so just giving people, the ability to build passive income through like actual rental properties and benefiting from that price appreciation. So that's, I think, the short-term vision of Homebase and like how we're launching. So our very first home is that it's a rental property that you can invest in. You can start collecting USDC every month. And that's us collecting rents and distributing them out to all holders. And then eventually you can sell it when you're ready. That's the first piece. I think the second piece of Homebase becomes we actually start to let homeowners sell equity in their home directly to retail investors through our platform. So once we've kind of built out the initial density of just rental properties, it's now about giving homeowners the ability to take out some equity in their biggest asset, which for most people is their home, and immediately getting some liquidity from that and still having the opportunity to live in the house. So that'll be a new concept that we're not launching with, but it is a mental shift because you do now need to start paying rent as a homeowner. But in a lot of cities like Austin, like New York, like San Francisco, it's actually way more expensive to be a homeowner than it is to be a renter. And this is just due to a 6 to 7% interest rate on a mortgage, HOA fees, property taxes, like so many different things that make it much more expensive than it is to be a renter. So we're going to give these homeowners the opportunity to sell directly to retail investors. And if you're a primary resident of that home, there's actually tax exemptions for you. You can sell up to $250K in capital gains tax, which is like tax-free effectively, or up to $500K if you're married. So there's actually an added incentive to sell and not pay taxes on that. And then the last piece of where we want Homebase to eventually become is a destination for renters. So when you're moving to a new city, instead of using Zillow or Craigslist, you use a Homebase platform, you find an apartment you like, you move in, you buy 10, 20, 30% of the home. Now you're a fractional owner of the apartment that you live in. And so that's really where we're going with this, kind of creating a liquid economy of fractional shares of properties. So that even though you don't own the entirety of the house, you still own like 10, 20, 30% and feel like a homeowner, renovate your place like a homeowner. And then when you're ready to leave, you can easily sell it in a liquid marketplace.
Okay, cool. Let's break down each one of those. So the first one, I have 3 questions. The first one is for the person that takes $100 and in a week or two, when you guys fully launch, they say, here's $100. And now they own a piece of a piece of a piece of the real estate property, of the rental property in McAllen, Texas. How much should they be expecting to see monthly or annually as far as return? I think when we were on our original call, you said something like 3 to 4%. Is that still accurate? What are you guys forecasting? We'll start with the rental piece and then we'll get into the other 2 basically financial products you've talked about as far as real estate.
Yeah, so I can't dive into too much of the details of the property itself, just because it is a security and we don't want to be like basically getting people to invest through a podcast, but it's going to be like in the 5 to 6% cap rate range now. So if you go to the website, you can see all details about the property. But we think the first home is a great deal without diving into the specifics of the numbers.
Totally cool. I understand that. You're also going to be launching soon. Everything we talk about also in this is going to be in the show notes. The tweet that you're going to put out will be in the show notes that shows, the changes in property value. We'll put that there. We'll put everything.
Amazing.
The second part is, it sounds like what you're trying to do is create almost like a HELOC for homeowners. Is that kind of what you're trying to do? Allowing them to get equity in real time without having to use a bank?
Similar to a HELOC, but I think with HELOCs, you can still pay them down and get back your equity. So here you're truly selling the equity of the home. So basically, like we would be fractionalizing the property. We'd be spinning up a new LLC that would be acquiring it. And then you as an owner would decide to keep however much percent of the home you'd like. So you'd get that much stake in that LLC that we're spinning up. And then the other percent of that would get sold to like the open public market. And so you still get capital exemptions on any sort of capital gains tax if you decide to live in the house.
Okay, that makes perfect sense. And then the last part is I'm living in Philly and I get a job in Tampa, Florida, and I move down. I find a Homebase home and I can move in and the house is worth $400,000. I can move in, pay $200,000 from my Philly home when I sell it. And now I'm a half owner of the Homebase home in Tampa. Is that right?
That's what we'd like to do. I think 50% is probably a little too high. Just thinking about like majorities, and we don't want like investors to get screwed. So I think we probably cap people at like a 30% ownership. But that's, I think, how we're thinking through it.
Okay, cool. Now, talk to me about timeline. You're about to launch imminently. By the time that this podcast comes out, which is going to be in late February, when is the launch date?
The launch date's February 28th, so in exactly 1 week from today. Or when this comes out, the day of, I think.
I think this will come out on February 27th, which is it's February 28th. Yeah, you're right. The day of.
Yes.
Okay, cool. What does that look like? What are you guys doing for your product launch? Because as you know, in product strategy in Google, whenever you do anything on the internet, you kind of got to make a good amount of noise, or people just don't, if a tree falls in the woods and no one's around to hear it, did it actually make noise? So what does it look like when you launch this? You're going to have the podcast, which aligns perfectly, which is amazing. What other stuff are you trying to do? And for people that want to buy, where can they go?
So where people can go to buy, just on our website, so there's a few things we have to do to comply with regulation. So we're effectively a Web 2.5 company, and that's just due to real estate has a lot of regulation. As much as I'd like to have things truly decentralized and anonymified, it's just not able to be a thing in today's like regulatory landscape. So you do need a KYC, and that means we have to know who you are, because we have to know that you haven't laundered money, that you're actually buying it with like your personal funds. The second is having a Solana wallet. So everything we're building is on the Solana ecosystem, so using that wallet. And then lastly, indicating if you're an accredited investor or not. So our offerings are Reg D offerings, so we can only have up to 35 non-accredited per investment, and then unlimited accredited. We eventually plan to do these as Regulation A offerings, which lets unlimited amount of non-accredited investors participate, but it costs more money to launch those and need to be further in our journey before we can afford them. But that is the vision. And in terms of what our strategy is at launch, so spoke with the head of growth at Smoothie. We're going to be having like, what Smoothie is like they're the product hunt, but for Web3 companies. So having a launch there next Monday. We've been working with the Solana press team. They're helping us spin up like a press release that hopefully gets picked up by a few journalists and launch for next Tuesday about how we're tokenizing the very first home on the Solana blockchain. And then we also have a press release with Bloomberg planned for next Wednesday. So hoping the stars need to align for everything to come out around the same time. So fingers crossed it does. But worst case scenario, we have this podcast. So thank you so much, Jared.
No, absolutely. Absolutely. And I actually, on our original call where I was also with my buddy Grant from Not Crypto Bros, shout out Not Crypto Bros. Grant is very much into real estate. And I can share with you an episode after where he talks about real estate stocks and crypto and how he balances the portfolio. And one of the things I think I asked you on that call, or if I didn't, I should have, because I'm very interested. Why Solana? And I asked that as we're in a moment where DeGods, which is the biggest NFT on Solana, is migrating to Ethereum. So why Solana? Why not Ethereum? Go ahead.
I think this was a decision we made like mid last year, and it came after us looking at a lot of different blockchains. And I think for us, it was always like, okay, we need to go where users are and where developers are. So of course, the biggest ecosystem that comes to mind is Ethereum. And so we looked a lot at Ethereum. We looked a lot at Polygon. I think Ethereum didn't work for us because we saw the other side's land launch, which was like a big NFT project, part of the Bored Ape Yacht Club. And gas prices hit up to like $2,000 just to do one measly transaction. And it was like, we're trying to democratize access to real estate. We can't charge equal $2,000 to do a transaction. Then it was like, okay, let's think about Polygon, because they have also a ton of users. They've been growing. They have some big projects there. But the act of bridging, I think, is quite difficult for people. I've been in the space since 2017. I still sometimes hold my breath when I'm bridging my money, because you see it disappear in both wallets. And that's just like a bad user experience, in my personal opinion. Even having been in the space for so long, I could not put my girlfriend through doing something similar. She'd kill me. So that left to, okay, like now that we've kind of blocked those two outs, was like, what's the next big community? And so Solana really spoke to us just because, A, we had some friends also building companies in that space who had really good things to say about it. And then B, like we started integrating ourselves in the NFT space and like the Twitter spaces. And there's just so much chatter on so much socials around Solana. And also Packy McCormick wrote a really cool blog called Solana Summer, which I feel like really made me a Solana bull. I read a lot of his things. I'm not boring. Shout out to him. But I think that like so just the biggest communities, biggest developer communities, and ultimately speed of transactions, I think, is what led us to pick Solana as our chain.
Yeah, that's a great answer. Oftentimes, I'm not crypto bros, not so much on this podcast, but I'm not crypto bros, another podcast that's kind of produced by More Than Blockchain. We will pull up GitHub and we will just kind of look and see where the devs are going. And it's been very interesting for the past like 16 months to just see how they're flowing in between somewhere between Solana and Ethereum, Polygon a little bit, but like you said, the bridging aspect there gets a little funky. And obviously, Ethereum's gas prices are brutal. And if you're trying to have someone basically buy what I would assume is an NFT for $100, and if they have to spend $70 for gas, that doesn't really make sense. So good. I'm glad we covered that. I was like, that was like my one hot seat question for you. Um,
Absolutely.
uh, so you're going to start with the property in McAllen, Texas. You are from Texas. You are a son of immigrants. When we spoke on the call, you had said that you had mentioned that there are certain laws that Texas has around real estate that make it the perfect fit for what you're trying to do with Homebase. Can you talk a little bit about those? I think there was like in my mind, it was called a pass-through law.
I don't think it was pass through. It's transfer taxes. So there's a lot of reasons why like this model doesn't work in certain states and certain cities. So for example, Philadelphia has a transfer tax. I think is anywhere from like 3 to 4%. So if you sell $100 worth of a token, you now need to pay a 3 to 4% transfer tax, which is just way too high. Texas actually doesn't have any transfer taxes, so very easy to sell fractional shares. You don't get taxed on it. They're also very landlord friendly. So if anything happens with the apartments or the properties, like we as Homebase can manage them accordingly. And then they also are very kind to having multiple owners of an LLC. So they have really good like joint agreements for a lot of owners. While other states, it's much harder. Like New York City comes top of mind with like co-ops. Co-op structures here are very complex. So it would have been really tough to launch in New York. So Texas just made it where it's very easy to launch there, and they've been growing a ton. We looked at a lot of markets. It came down to like what has the best legal structures, what's growing, what'll do well in a recession when prices actually pull back. And McAllen just fit that bill really well.
That was totally it. It was not pass through, it was transfer tax. Thank you for correcting me. And what are some other states that you guys are going to look at outside of Texas that also have favorable transfer tax laws?
Yeah, so Arizona's one, Denver or Colorado's another. Sorry, those are the cities we specifically were looking at. We looked a lot at Denver, we looked a lot at Phoenix. Those probably are the three main we looked at. Just we looked at a ton of different markets. Those were like the top three, just based on growth, based on laws, based on ease of regulation and spinning up the LLCs we're creating. But ultimately decided with Texas for the reasons already mentioned.
Yeah, it makes total sense. I love that you guys are going to be in Texas and in McAllen. I think that's super cool. Looking long term, where do you want to be in 5 years? And what is something that could stop you from getting there? Because crypto is market driven, sentiment, things happen. You know, it's like if you were to launch this and then 3 days later FTX happens, it could have tanked your entire thing. There's a timing component that's brutal for, I think, Web3 entrepreneurs that you can't control everything. So, where do you want to be in 5 years? And what's something that you think could maybe not allow that to happen?
Yeah, I mean, in 5 years, I would really love to have enough density of properties in multiple big cities in which people can move in, buy fractional shares, be like a homeowner. And this is really targeted towards like people in the ages of like 20 to like 35. I would love if someone's first investment was not in the stock market. After they filled up their retirement account, it was buying fractional shares of the apartment they're living in. They start to build wealth and they start to lower their like cost of living because your rent goes down based on whatever equity percent you have of that house. So like that's my true dream for Homebase. In terms of what could like really make this difficult, so we really do want a DeFi based world, and we've had a lot of people ask us like, why are you even building this in the blockchain? Why do you need this? Like there's so much negativity around it. To us, it goes back to core principles of like why we even made that decision. We really like the technology stack. It's very transparent. At scale, it's going to be very easy to trade and like where people truly have ownership of their assets and can sell them and buy them as quickly as possible, all done via smart contracts. Um, but like if we have two more FTX scenarios, like if Binance went down, like that would really, really break the trust in Web3. And it would make it very difficult. So at Homebase, we tried extracting a lot of like the scary parts of Web3 and just really aligned ourselves to like what's the true value prop we're providing customers and people on our platform. But like if you're curious, here's how we're doing it on the back end, and like here's all the explanations in our white paper. Because ultimately, we really are going to have broader adoption of Web3 and crypto. People care about use cases, people care about utility. They don't care about speculation. Well, they do until it blows up, but they don't care about speculation, and they don't care about like vanity metrics. They like truly want ease of use and utility.
Yeah, I love that. And just looking through the website, getting ready for this episode, you guys do a really good job of not throwing a lot of crypto language in there. It's just fractionalized ownership of real estate. That's it. You know, do you want to take a part or not? This is how we go through vetting the properties. This is how we want you to build your portfolio, the word transparency. So I think you guys are hitting right where you can tell that you were in product right where it should be, because I think the most successful projects, and we talked about this in the last episode with Jack, but like when you look at Starbucks, people don't even know they're NFTs. I think it was like, I think, what did Jack say? Like 85, either Jack said it or I read it, but it was like 85% of people that are on Starbucks Odyssey don't even know it's on blockchain. It's on chain, like or it's tokenized. It doesn't matter, right? So I think that's super beautiful. Since I'm on the website now, I want to give you a chance. Where can people find more information about this, and where can they get ready? Because when they listen to this, they will probably be able to go click through and, you know, invest, take some Solana and buy some ownership.
Yeah, so if you go to the HomebaseDAO.io website, like everything on that site kind of caters you towards making an account. So I think we have a lot of call to actions there all around building wealth, starting that process with as little as $100, and this first home being kind of a big experiment. Like, do people even care about this product? Do people actually want this? We've done like almost 100 user interviews to even understand like why people care about this, and we feel confident about this, but that'll be our first true test. So if you are interested, go to our website. You do need a KYC once again. Everything's transferred in USDC. So it's all a stable coin. They were actually one of the few companies that did not get a subpoena, or I think it was like a bearer something from the SEC. A lot of other companies did. Circle was one of the few that did not. So we're playing everything by the books in terms of regulation. I think with FTX falling, there's been a lot of distrust now in Web3 and in crypto companies. And so for us, it's all about how do we build trust? How do we showcase to people that we're actually following all the right regulations? So our white paper really goes into detail about like what securities regulations we're following. How do we even create the tokens themselves? So that's all there and like very transparent. Even all the documentation for homes is linked for every single property to give that transparency. So we just want people to make the best educated decision they can and feel very blessed that they'd even trust us with some portion of their money.
Excellent. I will link everything below. Please go check out. There'll be the white paper, the Twitter, which is very active and nice, and the website. And I'm also going to leave probably your LinkedIn if people want to reach out directly to you to ask some questions. Domingo, thank you for hopping on, and I will see you at NFT NYC.
Yeah, absolutely. Thanks so much for having me, Jared. Very nice to chat with you, and look forward to seeing you at NFT NYC.
Absolutely. Thanks so much for checking out this episode, and be sure to check the show notes to get in touch with Domingo and check out Homebase's website. I'll leave his Twitter, I'll leave Homebase's Twitter, I'll leave his LinkedIn and the website where you can go on today, connect your wallet, and buy $100 of fractionalized real estate. As always, be sure to follow us on social media at More Than Blockchain, and if you haven't done so already, please go ahead and follow our YouTube channel. I'm putting up exclusive YouTube-only content there weekly, so go ahead and check it out. And no matter where you're listening to the podcast, please go ahead and subscribe. And if you enjoyed this episode, or you struggled with buying a home, or you're interested in getting real estate exposure, please go ahead and check out Homebase. Check out their website. It's in the show notes. I think this is a really cool model that we're only going to see continue to grow as it becomes more and more expensive to buy a single family home or just to get real estate exposure in general in your financial portfolio. So please go ahead, check out the show notes. And thanks once again for checking out More Than Blockchain. I'll see you next time.